As we've been talking about for a while, the market's set up here for a decent correction. So the bears are going to have a bit of a victory lap potentially over the next month or so.
Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart, welcoming you here back at the end of the week for another weekly market recap featuring my good friend, the verdant Lance Roberts. Lance, how you doing?
Doing fine. How are you today?
I'm doing good. First off, Lance, Rabbit, it is the first of the month. August 1st is we're recording this. Don't know if you guys have that tradition in Texas, but I grew up in New England, and you were supposed to say the first words out of your mouth on the first day of every month are supposed to be rabbit, so you have good luck all month.
Rabbit. It's too late though. I've been talking all morning. So
Oh, really? And maybe in Houston, you guys say something like armadillo.
it could be possum. I don't know.
Well, look, I picked verdant as your adjective for the week because we're going to keep this one short, folks, because literally I have to go to the airport right after this. I'm flying off to Ireland. I think I've let folks know that in the past. My daughter has been finishing up a study abroad trip this summer, so I'm going to meet her there for a little dad-daughter time in Ireland. I can't wait. First off, hopefully you won't really notice I'm gone because we'll be releasing videos on the normal schedule. I've pre-recorded a few. We've got a really good lineup coming. We've got Michael Howell tomorrow, the day after this video airs. Then we have Jeff Clark talking about the opportunity in mining stocks, which he sees as being very high still. Then I've got Joel Salatin, a little bit different fare, but those of you who saw my previous video with Joel understand he's one of the best people in the world, but doing one of the best things for the world in terms of helping our food systems shift to sustainable farming, an investment that's very important for society. And then the last, right before we get back, we'll have the video with Greg Lukianoff, one of the co-authors of The Coddling in the American Mind. You probably heard me mention that once or twice leading up to this week. I'm very proud of that discussion. I think you're going to find it really important, but also just really one of the better interviews I've done on this channel. So all that's ahead this week. Let's see, real quick. I wanted to thank everybody who helped me plan this trip. I had a bunch of people from Ireland sending me suggestions, many of which I've taken. I don't have a lot of time there with my daughter. Just FYI, if you're in the area, I'm going to be on the Aran Islands for our first day there. Then we're going to do the Ring of Kerry. Then I'm going to head up to the Northwest for a little bit. But on Wednesday, I might have time to do a little meetup in the Galway area. If you're in Ireland, you might be interested in that. Let me know in the comment section below, and I'll try to get the word out. And it looks like at the very end of the trip, Lance, I'm going to hop over to the UK and go visit Sven Henrik. And so hopefully there's going to be some clips on my X account of me actually chopping wood there with Sven next to his famous wood pile. So anyways, if you don't already follow me on X, folks, go to @MenloBear and you can hopefully follow along in the journey. All right, Lance, well, look, busy week. A lot has happened this week.
Yep.
And I got one question for you.
Uh-huh.
Is it time for the bears to just put on their horns? Is it time to just love the bull market and just get comfortable with it?
Well, that would be a great thing to say like 2 months ago, but as we've been talking about for a while, the market's set up here for a decent correction. So the bears are going to have a bit of a victory lap potentially over the next month or so. Markets are down nicely this morning. We're down about 1.75%. It's ironically, I just posted a chart this morning on X talking about the stretch of days that we've had, so trading days in the market we've had so far, which without a plus or minus 1% move. And that was getting to be a pretty long stretch. These are called buying stampedes. It's where markets just kind of go up every single day, and it's called a buying stampede. Normally, buying stampedes last about 15 trading days on average. So we're at 25, 26 trading days. So that's a very long, push. And so this morning, one thing we've talked about a lot recently is that low volatility begets higher volatility. And, we're on the first day of the new month. We just had a slate of economic data that's showing the economy is slowing down rather rapidly. And, which is surprising considering Jerome Powell's statement this week. He had to have the employment data going into that and, should have been cutting rates, but didn't. So here we are. We've got this, kind of good evidence that inflation's declining, economic growth is declining. That's going to have some implications to corporate earnings going forward. And so markets are kind of waking up to that this morning. But again, the markets were very overbought, very extended. we've had the longest stretch above the 20-day moving average since 1968. So, we're correcting that now as we speak. We actually cracked the 20-day moving average today. So, again, it was time to have a correction. We've talked about this over the last several weeks, take profits. And it's kind of got to be a bit of ad nauseum, like on our radio show every day. We're talking about, hey, take profits, reduce risk, rebalance your portfolio. We're going to have a correction. It's like the market just kept going up. And, it just takes time sometimes for these pullbacks to happen. And so we're having a bit of a pullback now. And it could very well last here for, another week or so to work off some of these previous kind of overbought conditions.
Okay, well, so a couple of things. First off, we're recording this earlier because I got to head off to the airport. So, I mean, today's 1% drop or whatever could very well reverse by the time this video comes out. So we should just put that caveat out there, right? And I do want to talk to you in just a second about the data that, in your words, shows the economy is slowing rather rapidly. Now, on the other side of that, we've had big beats by the Mag 7 stocks, right? A headline GDP, and we can talk about the GDP report, right? But headline GDP was a beat. And again, we can dig into that, but it was a beat. We had the ADP jobs numbers earlier in the week, which were a beat versus expectations. We've had more trade deals get announced. Now, we've also had the August tariffs kick in for everybody else who didn't strike a trade deal, but we've had some pretty big trade deals struck recently. So this is sort of why I started with, should the bears just put on their horns? Because we've had this relentless buying stampede in the market for so long, and a lot of positive headlines that obviously the administration at least is crowing pretty hard about here. So what's on the flip side of that?
Well, the GDP number is a great example of that. The first quarter GDP number, we saw a negative 0.5% print, and everybody was like, oh my gosh, it's so recessionary, but it really wasn't. The actual GDP report wasn't nearly that bad, because once you dug down into the numbers, you find out that it was all import related, right? We had this massive surge in imports that created a massive push within the GDP calculation, and consumer spending was, it wasn't super strong, but it wasn't bad.
Right. And sorry, just to be clear, just so folks understand, the surge in imports was everybody building inventory in anticipation of the tariffs, trying to front run the tariffs. So it over impaired the GDP print. It made it look a lot more negative than really what the economy was doing. Yeah.
Correct. And the same exact thing happened in quarter two is that now, since I stocked up on all the inventory prior to tariffs, I didn't need to buy any more inventory. So imports plunged by over 30%. That created this massive boost to GDP. But importantly, when you look at the numbers, personal consumption expenditures were made up about 0.98% of the GDP calc. Now, remember that GDP, 70% consumption, give or take. That was a fairly weak print for the consumer. So we're definitely seeing the consumer slow down. We saw that same type of slowdown in Amazon's report this week as well. So, we're starting to see more and more evidence of the economy is actually slowing. And once you dig down into that second quarter GDP report, it really wasn't all that good. And it certainly, bids to the fact that the economy and the main driver of the economy, the consumer, is slowing down. And then you take a look at today's employment report, as well as the revisions to the employment report. There was nothing good about that employment report anywhere. So, we're starting to see this, kind of, that data has been grinding slower for a while. We were doing 220,000 jobs a month, and we went to 175. And then, last month was 14,000 and 73,000. This report will get revised down next month as well. So, the evidence that the economy is slowing down is pretty evident. We see that in the construction manufacturing reports. We see that in the services reports. ISM manufacturing index came in today at 48. It was supposed to be 49.50, which is those are both in contraction anyway.
Right. So again, more contractionary than expected.
Exactly. So, it's just that impact. And so that continues to suggest that economic growth is slowing, that lowers the rate of inflation over time, because it's slower economic growth, and inflation is just a function of supply and demand in the economy. So if that's slowing down, you're going to have slower inflation, which is why the Fed, and we wrote this article a couple of weeks ago talking about the Fed's probably going to be, that President Trump's going to be right. The Fed's going to be too late. The Fed probably should have cut rates yesterday, given the light of this data that's coming in, which they had to have going into that meeting. They knew what this report was going to be.
Right. So I'm going to ask you to just put your Jerome Powell hat on and try to crawl in his brain. Is it stubbornness still? I just don't want to make it look like I'm kowtowing to Trump's bullying. Or is it more, hey, we've got all these new tariffs getting slapped on in October, at the start here in August, and I just don't know what the impact of those are going to be. And I just would rather err to the side of caution versus cut too early, which he's increasingly about the only person who's thinking it's too early at this point. But
well, the data certainly doesn't suggest it's too early. And the one thing that everybody forgets about tariffs, see, everybody assumes that tariffs are a constant inflationary impact. And that's not the case. Tariffs are a one-time inflation issue. So, just an example, this bottle of water. So if I slap a tariff on this bottle of water and the price of the water goes from $1 to $1.25, that's inflation, right? So it's a one-time inflationary impact. I'm now paying $1.25 for this bottle of water. Next year, the tariff hasn't changed. So the price of the bottle of water next year will still be $1.25, which means I have what? Zero inflation.
Zero inflation. Yeah, we've talked about this. This is why I've been saying it's a price shock. It's not
right. Right. But this is a critical point. And this is the point that I think Jerome Powell, he's so trapped up. My belief is that he's so afraid of getting caught in that, kind of transitory impact of inflation that he said back in, 2021, 2022, which is, he was right. Inflation was transitory. It just didn't evaporate as soon as they expected. And he's so afraid of getting trapped into that cycle again. I think that's he's like, oh my gosh, we might have this inflation boogeyman crop up. And it was the same trap that Alan Greenspan got in back in 1999, kept expecting this inflation to show up from the internet bubble, and it never did, and then led to the dot-com crisis. So, so I think the Fed's just getting themselves wrapped up into a concern that, really they shouldn't be focusing as hard on as paying attention to the economic data, which the trend of the data is clearly slowing and clearly suggests that the economy is getting weaker. And that's not just 1 month's of data. That's the data from the last few quarters has showed this weakening trend within the economy.
Yeah. Now that being said, there's nothing, and correct me if you think this is wrong, but there's nothing that is suggesting the economy is like breaking down and that like recession's imminent, or we're near some sort of precipice of falling into negative economic growth anytime soon. It's just a slowing economy, correct?
Right. Yeah. There's nothing on the horizon right now that says, oh my gosh, we're about to have this massive recession.
Right. Jobs are still growing.
Yeah. The economy is growing. It's just growing at a much slower rate. And it's like we talked about previously. If you take a look at a graph of GDP, you can clearly see where we shut down the economy in 2020 and then sent everybody money, right? And so you had this massive surge in monetary supply and no activity. So all of a sudden, I've got a big supply-demand imbalance because the people that want to buy stuff, they've got money. We sent them checks, right? We did the unforgivable. We sent checks to households and said, "Here's money to spend," and they go, "I can't spend money." So whatever I can buy.
They empty the shelves, but the shelves couldn't be restocked because the supply chains were shut down.
Right. Yeah. And so for whatever things they wanted, they were all of a sudden willing to pay, $10 for a bottle of water versus $1, right? Just to be able to get it. So that's where that inflation spike came from. But you can clearly see this. So we had almost on a nominal basis, we were growing at roughly 14% nominal GDP in the second and third quarter of 2020. So coming out of that, we sent all these people and the economy exploded. And so it takes a long time to get to negative growth rates. And this is why everybody's been wrong over the last several years. Like, oh, we're going to have a recession. You've got to go from 14% growth to negative growth to get to a recession. That's a huge trip down the mountainside, right? And so we've been slowly declining on that economic growth rate, and we're back down to around 2% growth. We'll probably be sub 2% growth this year. The risk of a recession is now becoming much higher because now we're in the bandwidth, we only have to clip 1.5% off the economy to get to negative growth. So we've now got the highest potential that we've had in the last 5 years of actually having a recession over the next couple of years. We've now got that ability because we're so close to that kind of zero rate of economic growth in the economy.
Yeah, and let me just go back to something you've said a lot over previous quarters, which is the economy has decelerated a lot over the past several years, but it's because we started at such a massive height, that sugar rush that you just described, right? That even though it's decelerated an awful lot, we had a lot of distance that we had to cover on the way down. We were still, in positive altitude. Now we're getting kind of close to the ground, to your point. So, any material further deceleration of the economy gets us closer to the zero bound in terms of growth, right?
But yeah, no, that's right. And we're now getting back towards that kind of zero bound of growth, where now if you have an economic shock of some sort, you have some type of event that comes along that all of a sudden really constrains consumer spending. And again, most important, when you're looking at the economic data, remember that 70% of the economy, right? It's like 68%. We're just rounding to 70, makes it easy. But about 70% of the economy is consumer spending. So what you really need is, business investment can go off to the moon. But if 68% of the economy is slowing down, it's going to drag the whole GDP report down. It's just, these smaller components, imports, exports, net exports, 15% business investment, those are such small factors within the overall calculation that it really just pay attention to the consumer, tells you all you need to know. So, again, if we have some type of economic event come along that really shuts down consumer spending, whether it's, some type of corporate disruption, some type of credit related event with some major banks, whatever it is, that could have an immediate impact on the consumer, and we could be in a recession like that. Because again, we're so close to that bound now. 1.5% growth is easy to clip off. Clipping off 5 or 10% is a much different story.
So let me just dig into that for a second. So I agree that we're much more vulnerable maybe now than we were a year or so ago to kind of the black swan type thing that you're talking about, right? The bullet that the person didn't see coming. But let's talk about kind of some white swans out there, right? So one is, the economy is still a bifurcated economy. I mean, the hyperscalers are just crushing it right now, right? But a lot of the rest of the economy isn't growing nearly as well, right? And where are the jobs? The jobs that at least haven't been automated yet, are still in the small to mid-sized companies, right? So as the economy continues to become more sluggish, right, as interest rates continue to stay high, or bond yields, the cost of debt continues to remain high, and corporate credit keeps re-rating, that puts more and more pressure on those companies, right? Yep. And so that's just when we're just over time. Time is not your friend in that scenario if the cost of credit isn't coming down. And those companies presumably will still, will have to start cutting costs and perhaps laying people off. And then that could trigger what you're talking about, right? Similarly, we have the student loan repayment thing that we've talked about, right? Where that is pushing people to have to compromise on other types of debt. And we're seeing delinquencies and subsequently defaults start to rise over a lot of these things. And again, that impairs both consumer spending, cost of credit, et cetera. So we've got some white swans that, given enough time, if we get low enough in altitude, could tip things below the zero bound.
Yeah, no, absolutely. And this is, I want this is where we need to be real careful, right? Because we're not saying that, hey, we're on the cusp of a recession, you better sell everything and get out of the market.
Right. And that's why I asked you that at the beginning. I don't want to give people that impression.
Yeah. We're not saying that at all. But we do have to realize that that the economies do cycle, and that you're going to have growth phases, and then you're going to have a peak, you're going to have a growth peak in the economy, and then you're going to have a growth slowdown, and then you potentially have a recession, and then you start to cycle over again. It's just the way markets and economies work over time. You just can't go up forever, right? You've got to have these cycle resets over time. And so the risk of, and what I am saying is that the risk of a recession is certainly becoming a lot more probable now than it was in 2021 or 2022 or 2023, when all the economists were saying, oh yeah, we're about to be in a recession, there was really no evidence that we were even close to that. Now we're starting to have the level of growth, the level of employment, those type of things starting to say, hey, the spread between a growth cycle in the economy and a significant slowdown or a recession in the economy, that spread is now very close. It's just basically turn a corner and we're going to have much slower economic growth or a recession potentially. And again, we're talking about, and also too, let's clarify something. When we're talking about a recession, we're not talking about a 2008 financial crisis. We're not talking about a dot-com crisis. We're just talking about a normal garden variety, slower growth environment where the economy grows at negative 0.5%, maybe negative 1% at most. And then the economy turns around after a couple of quarters and starts growing again. That's what we're talking about. And that type of environment, markets, stock markets correct by 20 or 30% potentially, peak to trough, but it's not this absolute bloodbath that everybody's kind of been expecting to occur. It's not going to be that, because we don't have the catalyst sitting out there potentially. We don't have like a subprime credit issue. We don't have, while we've got some hyperscalers that are, kind of dominating the market, you take a look at their earnings, they are printing money at these companies. We're not talking about the massive number of dot-com companies we saw back in 1999 that had no earnings, no value, right. No business plan. They just stuck a dot-com on their name. Vastly different stories today. So again, don't speculate when somebody says, oh, a recession is possible. Don't start loading up your boat expecting a financial crisis, because we just don't have that right now.
Okay. Yep. And, folks, if and as we tip near the line of recession, we'll be tracking it here on the channel. So hopefully we'll give you lots of advance warning on what's going on here.
Absolutely. And if something starts to crop up, we start seeing credit spreads blow out, something like that, we'll be the first one, hey, there's something cracking on the financial side, right? Beware, raise a lot of cash. We'll definitely be there with you. Right now, we just don't, there's just none of that evidence in the market.
Okay, so we're getting pretty through the current earnings season at this point. Credit spreads, I haven't looked at them in a while. I'm going to assume they're not really blowing out yet, Lance, or I guess you would have already brought it up.
Yeah, no, the credit spreads are as tight as they can be.
Okay, so credit spreads are still really tight. I know that you've been saying for a long time that forward earnings estimates are really rosy. Now that we've gone through most of this earnings cycle, has what we've heard given validation to those rosy estimates, or is it giving us a sense that, yeah, those things are still pretty pie in the sky?
No, they're still very elevated. Now, what happened was, going back to March, when President Trump started announcing tariffs, and then we had Liberation Day, all of a sudden, analysts slashed estimates. And so this big sharp drop in estimates. And then as soon as that kind of Liberation Day passed and the market rocketed off again, all the analysts had now ratcheted their estimates back up to where they were before and higher. Oppenheimer just came out this week and put a $7,100 price target on the S&P by the end of this year. Wells Fargo's right behind them at 6,900, I think. At 7,100, that's a 20% gain for the year. To put that, but that would be the third 20% gain year in a row. So again, whatever concerns there were about earnings and the market in April and May because of tariffs, and this whole terrible outcome that was going to happen because of tariffs, Wall Street's like, yeah, never mind that. Here we are. So.
And this is in the context of a slowing economy, as you've been saying. So to use your parlance, this seems to be a negative divergence between earnings estimates and what the economy is actually doing.
Right. And again, if you take a look at, if you want to kind of know where earnings estimates should be headed, take a look at personal consumption expenditures. There's a very high correlation between personal consumption expenditures and the annual rate of change in earnings growth. And if you are wondering why that's the case, it's because that's where earnings come from, is from what people are spending in the economy. You can't just manufacture.
That's the 70% of the economy that you're
talking about. So you take a look at Meta's earnings, right? Where did all their earnings come from? The vast majority of it. They had huge numbers, but where was the majority of the growth and the revenue came from? It was from ad spend. Where did a big chunk of Google's revenues come from? Came from advertising. Well, if there's, how are they making all this money on advertising? It's because people are buying ad space from them to go sell products. So again, that's, the consumption into this is what drives earnings for these companies. And we do have, and it's interesting because you talked about, kind of these, hyperscalers. If you take a look at the heat map in the market yesterday on Thursday, it was very fascinating. So Wednesday night, we had earnings from Microsoft and Meta, blowout numbers. If you took a look at the heat map Thursday, you had these three bright spots, right? It was Microsoft, Meta, and Amazon. Big, bright green spots on the heat map. Everything else was red for the most part. There was a few little pockets of green here and there, but for the most part, it was mostly a sea of red. And, and what that was telling you is that, great, we've got these three companies that are just printing money. The rest of the economy is kind of just hanging in there for the most part. And we've seen that a lot lately. You take a look outside of kind of the technology stocks, staple companies, which are, you're kind of the core of the economy. They're kind of just middling along right now. They're not doing great. They're not doing terrible. Healthcare has been under a lot of pressure because of what's going on with the healthcare sector. Real estate is hanging in there barely, but they're still being pressured by interest rates. So you take a look at a big swath of the economy, it's just kind of middling along right now, which is kind of what the economy is doing. And so again, this is, if you want to know where earnings should be going, and two more things real quick.
Yeah, sure.
Take a look at personal consumption expenditures, but more importantly, if you take a look at the deviation of earnings estimates right now from the long-term trend growth of earnings going back to 1900, you're at the highest deviation level ever on record, period, bar none. We've never been higher in terms of a deviation from that long-term growth trend. There's about an $80 differential between where earnings should be and where they're trading right now.
Wow. Okay. Well, that's a pretty declarative point there.
Well, here, hold on a second. If you I was trying to grab a chart of this real quick. This is where we are. So this is the deviation of earnings above and below the long-term growth trend line going back to 1900. So we just hit 42.62%, was higher than the 42.57% in the real estate credit bubble. So again, that's what we're dealing with right now in terms of these estimates. And again, these estimates always fall short. They always get revised down. That's why we have millennial earnings season, on a regular basis. But that's what's going on right now.
Wow. Okay. It's another great example of, historically stretched valuation metrics. So I'm going to add that to the pile, Lance. I mean, we've got a lot these days, right? So a couple of things. First off, a couple months ago, when stocks started rocketing back after Liberation Day, and had surpassed the pre-Liberation Day's highs, I think I recall you guys saying, "Hey, look, we expect this to continue to be a volatile year. Sure, maybe the S&P can finish up 5% or 7% or something this year." And you had a price target for the end of the year at RAA, and I think you said we're not raising our price target, but we think we could we could come in at the higher end of it now.
Yeah.
Are you guys changing your price target at all? Are you moving in higher based on all these other much higher estimates you're seeing out there, like the 7,000s?
No, not right now. There's still the real risk that we could have another 5 or 10% correction sometime this summer, August, September, then rally into year end, kind of get back to where we are now and be up 8, 9, 10% for the year, which has kind of been our target since the beginning of the year. We said, hey, look, it's very reasonable. We could make an 8, 9% return this year, but with a lot more volatility. And we've certainly had a lot more volatility. The market's up about 8% for the year. And, from where we are right now. And so if we give that back and then rally back to where we are, maybe a little bit higher, we're probably not going to be too far off that mark. But again, there's, trying to predict a year in advance is a crapshoot. And what's really more interesting to me right now is that you got record level of retail options trading in terms of volume. You've got this whole meme stock thing. I mean, you've seen what's been going on with, companies like American Eagle Outfitters and, some of these other, $3 stocks that have had just huge runs. We've got this whole meme chase, back again. The most shorted stocks are, performing the best this year because it's a lot of speculation. So the one thing that really concerns me right now is just this real kind of record level of speculation that we see going on. It's we talked about this before, it's so reminiscent of what we saw in 2021. And the thing is that it doesn't mean that it ends tomorrow. But when it ends, I think there's going to be a lot of retail investors that are going to suffer very major losses in the markets. And right now they feel bulletproof, and you can't blame them, right? It's like whatever they buy, it just goes up. The more risk they take, they're just printing money right now. And so when you hear some old boomer like me sit there and go, "Well, you're going to lose some money if you do that," this was 2021. And the market did that for an entire year, actually a year and a half. The market just surged higher, very low volatility. I think our biggest drawdown we had during that entire advance was 5% at one point. But other than that, it was a very low volatility, just surging advance. And it didn't matter what risk you took, you got paid for it. 2022 though comes along and the market was down 25%, but most retail investors were down 45 to 50 during that because of all the risks they took. And unfortunately, I just think that's going to happen again. So, this is why we keep talking about, look, it's okay to take risks. It's okay to speculate. I'm not being just some old boomer telling you that, it's like, beware, get off my lawn. I'm not saying that. What I am saying is like, it's great to make money. Just don't forget to you don't make money until you sell something and put it in the bank. And, if you wind up turning all your gains into substantial losses, because you felt bulletproof, then what was the point, right? I mean, the whole point is if you're making a bunch of money, it's fascinating. I wrote that article about that guy in Canada that made like $100 million off trading some stock. He was leveraged up, did margin, was doing call options, and wound up with zero. And it's like, at what point did you have like, $100 million and go, you know what, I think I'm gonna put 20 million in a CD just in case, just in case I still walk away with 20 million bucks. But that's what happens to most investors. The greed factor takes over. They feel like they're bulletproof, and then something's going to happen. And something's going to happen to this market. Doesn't mean a 50% correction. Again, not saying that, but it's really possible if you're taking a lot of risk, options, speculation, leverage, you're going to lose a lot of money.
Well, a few things. One, we know right now that retail investors are more exposed to stocks than they've ever been as a percentage of their portfolios, and that the oldest cohort has the greatest exposure, which is ridiculous. It should be the other way around, right? The older you are, the more conservative investments that you should be having. But the retirement age demographic now has the highest percent exposure to stocks it's ever had, which just means, Lance, if there's an equity correction, it's going to hurt a lot more than it has previously.
Right.
So, but let me just say this too. We have the benefit of hindsight now, looking at 2021. And we can sort of say, okay, look, one of the reasons why it was so bulletproof for so long was because there was just so much stimulus that had been pushed into the system, right? Just trillions and trillions of monetary and fiscal stimulus, right? We don't have that now.
I know, which is the amazing thing about this whole rally is exactly that. It's baffling to me.
Yeah. So, I mean, I just think if you're feeling cocky, right, you have to have a really good, compelling reason why whatever tailwind you're counting on to continue from here is going to continue when you don't have that incredibly unfair advantage you had back in 2021, and the economy is slowing in the way that you've said, Lance.
Yeah. So, but again, markets can do phenomenal things, right? And they tend to always do exactly the opposite of what we expect. And, this is why, you and I spend so much time talking about narratives and contrarian investing and those type of things, because when everybody thinks the market's going to crash, that's generally when it doesn't. That's when, markets kind of take off and start doing something else. Or if everybody thinks the market can do nothing but just go up, that's when bigger corrections occur. And that's in everything. It's in the dollar, it's in gold, it's in stocks, it's in bonds. All these type of things go through mean reverting events at some time or another. We can assign all these narratives to them. We can say this asset price is going up because of A, B, or C. And we say this asset price is going down because of A, B, or C. But eventually that's going to change, and that asset price is going to start going in the other direction. Why? Well, because people see opportunities like, man, that's really beaten up. I can go put capital over there and I have enough capital to move that market. And all of a sudden I can start making money with it. And especially when things are highly shorted, like take a look at the dollar just over the last, couple of weeks, it's had a huge rally. So again, there's so much shorting on the dollar. It doesn't take a lot to squeeze that dollar higher. And there's traders making money off of that.
Right, right. Well, and it's just you cautioned us. Look, valuation's not a great timing metric, right? But you've also said, look, in the middle of the run, the herd is usually right, but it's usually at the extremes when the herd is wrong, right? And in the depths of the post-Liberation Day lows, nobody would have imagined that this year would close positive, let alone potentially up another 20%, right? And they were wrong, right? Now we're kind of on the other end of that level of extreme, right? Where now people are talking about it. Yeah, and a three-peat, 20%. And again, this could very well be where the herd may be proved wrong at the extreme.
Which is why we're not raising our price targets.
Okay.
Right. I mean, that's why. Look, I am still convicted, and look, I could be entirely wrong. But at the beginning of this year, we wrote that whole article called "Curb Your Enthusiasm," which was, basically saying, "Hey, just expect a year of a lot more volatility." And I still and we're still adhered to that premise, which is we still think that there's risk here of a 5% correction or so over the next month or two, and then a rally into year end. And we'll get out of this, and we'll say, man, we'll look at the market, and go, hey, market was up 10% this year, but you took a lot of bruises along the way, right? And that's the real question is did you survive that, or did you make investing mistakes by selling the April lows, buying the July highs, getting trapped up in the sell-off in August, September, and selling out again because now the market's going down because of tariffs or whatever, and then you miss the rally into year end? That's what hurts investors, is all the psychological mistakes we make in managing our portfolio over time. And we went into this year expecting volatility. We've been navigating based on volatility. We've given up some gains this year because we're holding 12-15% cash right now. But that's okay, because we still think there's more volatility to come. And if I get another corrective sell-off over the next month or two, I'll put that 15% of cash to work for the end of the year. But again, we just haven't had the right setup for that just yet.
Yeah, yeah. And just to, talk about how volatility isn't quite dead yet. Today is becoming more volatile as we talk. The S&P is down about 1.5% now. Oil's down, what is that? Over 2%. We're seeing risk on assets like crypto get pretty banged up too. So, again, coming in, literally as I was writing, my notes for you today before the market opened, it was, should bears, put their horns on at this point, because it just looks like the bulls, have totally got this market, wrapped around their finger. Well, all of a sudden the bulls are like, whoa, wait a minute, maybe we don't, right? So volatility is not dead, to your point.
Yeah, exactly. And look, this is also the beginning of a new month. So it's kind of, portfolio managers are setting up for August, September. Everybody in Europe is going on vacation starting today. So if I'm a European money manager and I'm going to go on vacation for a month, I don't want to be worrying about my markets. So, I'm going to lighten up some of my exposure to markets and those type of things. And that's a kind of an annual thing, right? We know that. So you just have lighter trading over the next 2 months. So it just means a little bit more volatility. But again, let's go back to earnings real quick. We've had a very, very good earnings season, 85% beat rate, give or take. The problem with that is that we lowered the bar so much going into earnings season that the beat rate was going to be expected, right? Okay,
so, but that's your whole thing. Everybody's getting their trophies right now.
Yeah. Well, the problem is now that bar is a lot higher. The analysts have been ratcheting up their estimates for the third quarter, so they've now moved that bar up for the next quarter. And while a lot of companies were beating earnings, they were beating earnings by a little bit on a much lowered bar. So if you raise that bar too much, it's going to become much more of a challenge to beat those earnings in the next quarter. So especially if we continue to see economic growth slow down, if we have any type of growth hiccup at all, third and fourth quarter earnings announcements could be a lot tougher.
All right, we're we're going to have to wrap up
I know.
somewhat soon.
I know.
So no, I know, but just a couple of things I want to squeeze in. One, Lance, can you, while I'm talking here, pull up the chart? I just want to make sure that folks see the TA, because especially it looks like if we're coming back down to that 20-day moving average and maybe in some interesting technical territory, I want folks to see that. Let me just ask you this as you're pulling it up. Back to the Fed discussion this week. It is a little interesting that, Powell should have known what this payroll report was going to be like, but he didn't seem to be sweating it at all. But there were two dissents on the Federal Open Markets Committee, and that's rare. I think it's actually the first time since 1993, I think, that there were two dissents. And notably, the dissents were Fed governors. So the presidents of the Fed banks tend to be, the more sort of cynical ones. They're closer to the data of the real world. The governors are more sort of political appointees, and they tend to just sort of line up behind the Fed chair. But you had two governors who dissented. Now, the skeptic in us could say, well, they're just competing for Jerome Powell's chair, and they're trying to signal to Trump, hey, Trump, I think like you do, pick me, right? And that very well could be going on. Or, Lance, I'm just curious, how much do you think of it as that sort of posturing versus them looking at the same data that you're looking at and saying, whoa, wait a minute, like this economy is really starting to slow. We've got this jobs number the world hasn't heard yet, but it's about to come out. It doesn't look so good. Yeah, maybe we should start cutting.
Yeah, no, I think it's part of the latter, is that the data again suggests that they should be cutting. And again, this was the first time we've had two Fed governors dissent. It's very unusual that happens. Generally, they're much more in line. So again, I kind of think at some point maybe Jerome Powell's got to be sitting back today going, maybe I should have cut. Maybe I should have gone kind of thought about this, or at least been a little bit more cautious in kind of, because if you take a look at this is kind of press conference and the announcements after, it tilted a little bit more dovish. It wasn't as hawkish as it's been, but maybe he should have been a little bit more dovish about, or at least tailored his sentiment, saying, hey, we're not cutting today, but we're really watching this economic data, which is weakening, and it's very probable that we're going to be cutting rates maybe at the next meeting, whatever, or at least alluded to that a little bit more. Maybe the markets would, kind of responded better, but we'll see. But, but no, I think that part of, the two Fed governors is that they're looking at the economic data saying, we want to be ahead of this, not behind it. And that's the real risk. As I said before, the risk the Fed runs is getting caught flat-footed, and they're having to cut by 50 basis points at a whack. And why that's important is that if the Fed just cuts rates 25 basis points, say yesterday, it says, hey, we're seeing some weakening in economic data, nothing critical. We're not on a recession binge. We're seeing it slow down. We're going to go ahead and cut 25 basis points because the current Fed target is well above the current inflation rate. So we need to kind of reduce that break on the economy a bit. Markets will be really good with that. What the markets aren't good with is we're cutting 50 basis points today because, we just, hit an air pocket in the economy.
Right.
That markets do not like that. And that's where you run that risk of a much sharper reversion in the stock market.
All right. I'm going to steal the screen for just a second here.
Yeah.
Because as you were talking, I pulled up the latest FedWatch data here on rate cuts. And I just want to show you. So right now, there's an 80% probability of 81% probability of the Fed cutting in September. Now look at this. So it's 80.8 down here. Just yesterday, it was at 37.7.
Yep.
Right. So massive sentiment shift in just the first few hours of trading here today.
Yeah. Amazing what a bad employment report will do for you.
Yeah. Isn't that? All right. Sorry, I just wanted to put that corroborative evidence up there. All right. So if you want to pull your screen back up here, but we can see here. Yeah, clearly. I mean, today's action at least has punched us notably below the 20-day moving average. And as you said, we've been hovering above that thing for a very long time.
Yeah. And again, so we had a very long stretch. As I talked to you before, I think last week, that blue line at the top, that kind of diagonal blue line, and the line on the bottom we laid out probabilities about 3 weeks ago. We said about a 50% chance this market can continue to rally, 35% chance that the market declines, has a bigger correction back towards 6,000, and about a 15% chance the market just went sideways. So right now we're in the 15% chance the market's just going to be traveling sideways for the next, couple of weeks. I don't think that's going to be the case. I do think we try to work our way down towards that red line, which is the 50-day moving average. That would be very normal and would give you a much better entry point for the market. We've got about half of the relative strength overbought condition now reversed. And you can kind of look at whenever you have peaks in relative strength, the market tends to kind of sputter a little bit. So we're kind of working through that. We got a MACD sell signal at the top. So momentum clearly showing a decline here as well. And then that shaded area in the background, that's money flows clearly declining. And you can see that even though the market was flirting with all-time highs, money flows were declining. And that was telling you also, and this is why we pay a lot of attention to money flows, that was telling you that the momentum of the market was weakening and that buyers were becoming less available for sellers. So again, as always the case, what causes this is that people are wanting to sell and the buyers are going, yeah, I'll buy from you, but I'm going to buy at 62.43. I'm not going to buy from you at 6,400. Right. So what right now there's some buyers sitting there, but tomorrow we may find out that what buyers were there at 62.40 are now down at 6,200 or wherever. And we kind of work our way a little bit lower. And I suspect that could be the case over the next week or so.
All right. So if it does go down to kiss the 200-day moving average there, Lance, and barring there's no, massive sign of calamity, right? I assume that you're going to start buying there.
I might buy at the 50, depending on how far we are oversold at that point, and if the market starts to stabilize at the 50-day moving average. But
I'm sorry, I meant the 50. The 50 is the red one there, right?
Well, no, but the 200-day is also very important because markets do regularly test the 200-day moving average as well.
Yeah. I know. I'm sure you would load up there, barring no calamity. But you're looking at your red line here, your dotted red line. If you were to get down to that, I would think because you were thinking that was the low of your probability set, you'd start buying there in some material amount.
So what would be determinant of that, Adam, would be two things. One, I'd want to see relative strength closer to 30 than 50. So I'd like to see this come down a little bit more. The second thing is I'd like to see this momentum indicator, which is very overbought right now. I'd like to see it work itself back down towards zero from 80. Now, that might entail a bigger correction, like 5 or 6% in the market to do that, which would get us closer, by the way. From peak to trough, it's about a 6% decline to the 200-day moving average. So it's not that far. It looks big, but it's not that big. Which would be 5% correction, completely normal any given year. So again, somewhere in this range, we'll work off some of this overbought condition and have a lot better entry point. And I've got a shopping list of stocks that I'd like to add to in our current portfolio and a couple I'd like to buy. But again, we need to see better entry points to do that.
Yeah, and I imagine another thing you'd want to see there too is capital inflows growing again. And we've seen, and I'm talking about this sort of yellowish chart in the middle here. We've seen that really fall off as expected, I imagine, during the buyback blackout window, right? So I'm presuming that, we're getting near the tail end of earnings seasons. Once we're through that and companies can start buying back again, I'm assuming that would be another sort of all clear signal you'd be looking for, that like, okay, capital flows are starting to go up again.
Yeah, absolutely. So, so what you're looking for and with money flows is you're looking for it to bottom and turn back up. So again, I mean, what that means is you're not going to catch, I'm not going to catch the absolute bottom. Like, this was the April 6th, 7th lows right here. And then the market surged higher. But, when on that market surge, you can see that money flows turned sharply positive. So that was kind of your buy signal at that point to get in. So what you're looking for is these reversal of money flows from going down to going back up to suggest that buyers are coming back into the market with more volume, those type of things. And that kind of helps you let you know is like, as if money flows are trending higher as they were like this whole period, that just means stay invested because you've got the kind of wind at your back. But when you start to see this deterioration, that's when you want to lighten up a bit. Like a couple of weeks ago, we saw this. We took profits in Palantir and GE Vernova and some other stocks like that. And we kind of rebased some of that money into some more defensive areas of the market. which are holding up better today. We bought Costco, which is green today, while the rest of the market's down. That's what you're looking for. Is you're looking for that ability of money to rotate within the market, go from risk on to risk off, catch that rotation in the markets, and then once those money flows bottom and start to come back into the market, then you can rotate more back to your risk on type stocks. So that's where we'll add back to the more higher beta, higher growth type companies.
Okay. I want to get to your trades in just a second here, Lance, but I do want to talk for just a moment about bonds. So on the day we're talking here, the 10-year yield has dropped by 2.5% or so. Meaning, as investors become more concerned about a slowing economy, and obviously a disappointing or discouraging jobs report, treasuries seem to be, still exhibiting their safe haven role, and that I think has been part of the optionality part of your bond trade there at RIA, right? Which is, hey, you think the trend is going to be downwards in these bond yields in general, but if there are hiccups along the way, that capital still is going to seek shelter in the long bond. True?
Well, yeah, but also remember that again, just caveat is that we have to own bonds because we run allocated portfolios, right? So, but like in our 60/40 allocation model, only 5% of our portfolio is long duration bonds. The other balance of that is either cash or treasuries running between 1 and 5 years. So we're on the much shorter end of the duration risk curve of that, because when the Fed starts cutting rates, that's the first place it goes. So we'll see the biggest capital appreciation from a Fed rate cut in September on that end of the balance sheet. And then once we start to see economic growth slow more and start to see the capital flight from into bonds out of other assets, then we'll shift that duration to long end and pick up and add to our longer duration bond exposure to pick up on the reversion of economic growth and inflation, which then benefits the price of bonds on that end. So there's a bit of management to it. It's not just a stagnant kind of buy and hold strategy, but that's where the premise is. And importantly, if you take a look at treasury bonds, is like the TLT, it's forming a very interesting inverse head and shoulders pattern right now. It's been basing here for quite a while. We've been traveling between 4.1 and 4.45%. And if you take a look at treasury bonds, they're forming an inverse head and shoulders, and the US dollar is now forming an inverse head and shoulders and starting to break out of that. So if we start seeing more foreign reserve capital going into the US, which we just had the largest capital flight of dollars into the US since the April lows. We just set a record, like $1.7 trillion of foreign inflows into US capital. If we see a lot of that, if we start seeing reserve currency shift back into that area as well, then you've got a lot of potential upside in the long bond as well as the dollar.
Okay. All right. Well, folks, we'll be tracking that closely then, if those trends continue from here. All right, Lance, got to start wrapping it up here. Trades. What trades, if any, have you made over the past week?
Now, this past week, like I said, we went into this, at almost 15% cash. We've already done rebalancing in the portfolio, so we didn't really need to do much right now. And the stocks that we own are holding up really well. I mean, right now, I'm looking at the market. The S&P right now is down 1.61% for the day, and our portfolio is down at this moment 25 bips. So, if the portfolio is down 25 bips in a mark, and, a 60/40 allocation right now is down 73 bips. So, I can handle a 25 bip down day in a market that's down 1.6. So, again, I think we're well positioned for this type of volatility. And we were actually outperforming the S&P earlier this week, because of our weightings in stocks like Microsoft and Google and others that perform very well.
And folks, this is why the science of investing is so important. And Lance and I spend so much time on these videos talking about things like risk management and diversification and position sizing and rebalancing and all that stuff. And I know, Lance, when the markets are stampeding the way they've been over the past bunch of weeks, you get some people that are like, dude, why are you not fully allocated in your model? Why are you holding on to this cash balance, right? And, it can be, this way, I'm sure it's not very fun for you to have to explain to people why you're doing this, but of course it makes all the sense in the world when you have a market turn. Today is just, Is it the start of something? Is it just a blip? We don't know yet. But to your point, when you show those relative performance differentials, that's where you really appreciate following the science.
Well, and true. And see, that's the hard part for people to kind of understand. So our 60/40 allocation model is now this is through yesterday. It hasn't captured today's. This is returns as of yesterday. So if you go to simplevisor.com, which is our kind of do-it-yourself research platform, then you'll find some portfolio models that are there. And we're about to add a whole bunch more starting next week. We're going to have 8 thematic models as well as an additional kind of managed model as well. But I funded each one of those. So when you're looking at that performance, you're actually looking at the performance of a Fidelity account that I'm actually trading. So it's not just some random model, et cetera. It's an actual account. And we track all the trades. So you can look at the transactions, everything we bought and sold historically. This model goes back to 2019 when we started. We started it in January of 2019. But you know, it's interesting because you're right. When we're having this raging bull market, it's like, why are you holding 12, 15% cash in your portfolio? And I'm like, well, because it doesn't matter. Right now, I'm trying to hedge some risk. The 60/40 equity model is up 6.76% for the year. As of yesterday, the S&P was up 611. So we're traveling along with the index right now, but still holding less. We're holding more cash. We've got lower volatility, more cash, and we're still tracking along with the market as it is. So
right. To be matching the market with less risk.
Yeah,
that's everybody's goal, right?
And
you sleep better at night.
Yeah, and I actually misstated because I said that was yesterday's numbers. It's as of today. So I just got the live update. So
okay,
as of today, the equity model is up 6.76 and the S&P is up 611 with this decline today. So again, it's okay. I'm not trying to. The S&P is not my benchmark. My benchmark is another 60/40 index. That's my actual benchmark for that model. But the point is that I can run a risk reduced model and still perform well with respect to the market without taking as much risk. I don't have to have all the risk and potentially take all the risk of a drawdown, which is the thing you're trying to avoid.
Okay. Well, look, let's start to wrap it up here, folks. But exactly on this point, if you would like to get some help in having your money managed in a way that leverages that science we're talking about here, and brings in, all the tried and true best practices of portfolio management, and can help you keep your head, especially at moments where the market may be turning like it might be doing right now, but certainly if volatility continues to return to this market. If you'd like to benefit from that type of discipline, and I highly recommend that you seek the guidance of a good professional financial advisor, one that takes into account all the issues that Lance and I have been talking about here today. If you've got a good one who's doing that for you, great. Don't mess with success. But if you don't, or you just like a second opinion from one who meets the criteria, perhaps even Lance himself and his team there at RIA, then consider scheduling a free consultation with one of the financial advisors endorsed by Thoughtful Money. To do that, just fill out the very short form at thoughtfulmoney.com. And the firms will be in touch with you immediately after you fill that out. All right, Lance, I'm officially putting on my vacation hat right now.
Good.
And folks, if you want to follow along, like I said, go follow me on X. The handle there is @MenloBear. Also make sure you show Lance a lot of love while I'm gone. Go watch his videos on his channel every day. But also show them love by hitting the like button and then clicking on the subscribe button below. Lance, my friend, I'll talk with you off air here. There's a chance I might be able to sort of find a little window and we can record another short market recap next week. Or maybe if you're free and you and Michael just want to sit down and record something on your own, we could do that too. We'll talk about it off air. But I'm going to try not to bug you much next week. But who knows? Maybe we'll do a little thing from the road.
Yeah, no problem. And starting next week, so I was on radio for 25 years as of this month, and so today was our last day of actually doing live radio. We've done a live radio broadcast for 25 years. Today was our last official live broadcast. So starting Monday. If you've been listening to us on the radio all these years, thank you so much. It was a great honor, great privilege. We're just moving to all digital. So you can find us on YouTube. We stream live on X. We stream live on Meta. So again, go to our YouTube channel, The Real Investment Show. You can find our show there. And again, so absolutely, if push comes to shove, next week, I can just schedule a quick call with you or something, and we can do a short video for your audience, or we'll figure out something. Absolutely.
All right, great. Hey, look, 25 years. That is a massive accomplishment. Congratulations.
No, thank you. It's just definitely makes me feel old.
All right. Well, folks, definitely give Lance some love in the comment section below. Lance, buddy, another great week. Thanks so much. I'll see you on the flip side.
You got it.
All right. And everybody else, thanks so much for watching.
Japanese yen is one of the worst performing currencies versus gold, which in my book is inflation. I mean, not that gold isn't breaking out already, but I think silver will accelerate. And like Phil said, for people who haven't bought gold, I guess silver will be the alternative.
For a person, yes, you always want to go seek out as much gold as possible. When a system has a lot of gold revolving around it, you only get two things. You get more jewelry and you get higher prices. So if China reveals they have 30,000 tons of gold, like that, like we think they might, then that means prices in China in gold terms are going to be sky high, and prices everywhere else are going to drop like a rock.
25th of September, the consultation period over whether silver should be a strategic mineral in the United States will finish. They'll have to start building a silver stockpile. And we don't know how big that stockpile will be. Obviously, in the past, it was 2.1 billion ton. If there's a disruption in the supply from Mexico, which is where they're getting most of their silver from.
One of the worst currencies in relation to gold has been the Japanese yen, underscoring the growing pressures of inflation. Silver is predicted to rise quickly as a substitute for gold for those who missed it, even if gold is already starting to break out. By September 25th, the United States must decide whether to designate silver as a strategic resource. The government would have to accumulate 2.1 billion ounces, which is almost 3 years' worth of mine supplies, if it were authorized. Since Mexico supplies a large portion of America's silver, any disruption there might have a significant effect on the U.S. sector. Experts estimate that there is a 4% chance of such a situation. Mario Ineco, a famous market strategist, and Phil Lowe, a sharp macroeconomic commentator, both highlight that since April, the Dow-to-gold ratio has fallen precipitously, and it currently exhibits trends reminiscent of those seen in 2007 before the financial catastrophe. Long-term charts indicate otherwise, despite some people's concerns that a liquidity event may put pressure on gold and miners. It's evident that the trend is strong because banks like Goldman Sachs are now predicting that gold will reach $4,000 by mid-2026. While silver targets are already almost reached. The wider breakthrough indicates that gold's bull market is well established, even in the face of possible short-term pullbacks. As we dive into the video, remember to subscribe and tap the bell icon so you never miss an update. We value your thoughts, so drop a comment below and give us a thumbs up if you enjoyed the content.
This one here is the Dow-gold ratio, and we dropped quite a bit in April when we had that beginning of April, and then it's being consolidated, and now it's breaking down, and it looks a little similar to this, and this was in '07 before the great financial crisis, but I mean, we'll have to see anyway.
One thing I may, because we were just discussing Weimar, I do want to stress that Weimar was a very unique situation because the Entente powers were not letting Germany default. They said, you cannot default, you have to give us gold. And that's what stretched Weimar out to 2 years. I want to reassure the viewers, like, I think this will be over in 3 to 6 months once it really gets going. It's going to be brutal. It'll be as brutal as Weimar, but it'll be a lot shorter.
Yeah, but in Weimar, it started taking off. The hyperinflation really picked up in the summer of 1922, and by the 1923 it was over. So it was about 18 months. And
I think this will be about 3 months. I think they'll once they start losing control of food prices, I think they'll revalue to gold.
And I thought commodities were going to start a bull market in the early 2020s, only because bonds, I thought were going to start a bear market, and I thought hard assets will benefit in relative terms. But we see now that banks like Goldman Sachs, who usually just push paper and derivatives, they're actually telling their clients to diversify into commodities. And they even, I think they said that they expect gold well above 4,000 by mid 2026 if the Fed's independence is damaged. So I thought that was interesting.
Yeah, I see that. Well above 4,000 by mid 2026 in the middle of your page, Mario. I see that.
Yeah, it's here. Yeah, right there.
Their calls just follow the market.
Yeah. The other couple of weeks ago, Bank of America, which is another bullion bank, they said, "Oh, we're bullish silver. We see silver at $42 by the end of 2026." And I thought, that's not bullish. We're almost at 42 now. So, the bullion banks, I mean, I've been following them since I started following gold in '02. And I mean, now they can't do it anymore because gold is in a massive bull market. But for example, a few years ago, if gold was like 1,500, they'd say, "Oh, in the next few years, we expect gold to revert back to 1,000," and like so on and so forth. But now, they're saying they're bullish, but I think they're not bullish enough. And one of the reasons is these couple of charts here, and I'm going to bring them up. First one is a bit more short term, and this line here, we're going to see in the longer term chart. I think it's really important, and it was around 2,700, this line, and that's why I think we saw this pullback, in the retest. And now as well, I mean, we've broken out of this pennant or symmetrical triangle, and it's really taken off, and there's nothing like above here. So that's very bullish. I'm not saying we won't see any corrections, and then this one is the same chart, but really long term. And this is why that 2,700, in my opinion, was so important. And I was waiting for that test.
Wait, Mario, can you flip back to the other one so I can see
Yeah.
the difference for a second? Okay, yeah, and then go to the forward. Okay.
So this is from the high in 1980 to the high in 2011. That's where that 2,700, when we were breaking out here, I thought we might see resistance at 2,700. I mean, we didn't initially because it went up quite a bit, and then I'm not sure, it went 2,900 or something, and then it broke back down. I think it was after the Trump won the election. But now, I mean, we're really taking off, and a lot of people don't look at these long-term charts, and this is why I think people are concerned about a liquidity event.
Rafi Farber, known as the Endgame Investor, in an interview with Phil Lowe, Mario Ineco, and Clive Thompson, points out that China is injecting funds into its banking system through what it calls reverse repos, essentially providing liquidity much like Western repos. The government is trying to reflate its struggling economy, which faces weak exports to the US and a collapsing property market where apartments, once the main savings vehicle, are now oversupplied and losing value. This has left many Chinese households cautious about spending. While some argue China could rise as a global power, others believe its fate is tied to the West. If US consumers are broke, Chinese producers suffer too. On top of this, China holds vast US dollar reserves that may lose value, and even its large gold stockpile could backfire by pushing domestic prices higher and undermining exports. In short, both China and the West are trapped in the same fragile global system, and neither has outsmarted the other. Let's revert back to the...
This is the case. I think when China refers to reverse repo, they mean what we would mean by repo. I think they just got their terms.
Yeah, they are buying. I think they're buying the government bonds from the banking system and injecting cash into the banks.
Yeah, so
US
that's what we would call repo. In
Yeah.
China, they
Yeah.
call it reverse repo.
Yeah.
Whatever. It means they're injecting cash into the banking system.
Yeah.
I didn't hear about this. China is it they're like on a different wavelength because their interest rates are going down and down and down, and the West interest rates are going up and up and up. Um, I still think that when the West falls, China falls with it because they are the producers and we are the consumers. So if the consumers fall, the producers fall too. Like if you lose your customers, you lose your income. Or if the currency collapses in which you're getting your income, then you lose your income also. Uh, why China would be injecting cash now? I mean, we know. I mean, the place is very opaque. It's still communist, except for the special economic zones that they allow freedom in, so they can supply the West with a bunch of stuff, so they can stack more dollars. But China's economy has been so fake for so long, and they still have these ghost towns and this whole real estate bubble throughout the whole country, and it's still like a very corrupt, disgusting regime. I mean, we're not allowed. We don't really say that because the West gets most of its stuff from China, but that's still the reality, and it's gonna have to go.
Not very different though from our regimes.
That's true. No, I guess in the way it functions, no, but at least I mean the West still has an idea of individual liberty, whereas I don't think the Chinese see that as a value at all, other than maybe a temporary expedient. There's still a feeling in the West that individual liberty is a good thing in and of itself. In China, that was never there.
Things, the Chinese injection of funds, or
I mean, they want to reflate the economy. The China's suffering obviously from the slowdown in sales to America on the one hand, and secondly, the way of saving traditionally in China has been by buying apartments. So many Chinese people bought apartments, and now suddenly they're finding that the bottom's fallen out of the market because there's far more apartments or houses, if you like, than there are people to occupy it, and the population is not rising anymore. So and a lot of building companies have left these blocks of apartments which they're building and that people have paid for. They're half empty. So suddenly everybody is now drawing in their horns saying, oh my God, my traditional form of saving isn't working. And they're not willing to spend money on things. And so the Chinese government definitely has to reflate the economy. I think we're going to see more of that. I think that's just a first step, and we'll probably see more money thrown at the economy sooner or later.
Oh yeah, there's a lot of people who think that China is somehow eating our lunch, that they've somehow outsmarted us. That and I think your friend King Kong Eric Young is talking about the rest of the century is going to be the Chinese century, where China's going to move to the forefront.
yeah,
I don't
think
I don't
Jim
think that's true
Rogers
at
said
all.
that too, didn't he? Jim Rogers, I think, yeah.
Yeah, I don't think that's true at all. I think we're going to see. I mean, we're all going to go down together. It's not like it's not like we're going to do fine and they're going to collapse. They are holding enormous amounts of American dollars. We took all their stuff and we gave them dollars, which we're going to default on, and so all the people holding dollars are going to be completely broke over there. Not to mention they have overbuilt their industry, and maybe some people say, well, it's better to be overbuilt than underbuilt, but they're going to have a bunch of factories with absolutely no one to sell to because we are broke. America's broke, so we can't buy any more Chinese stuff, and there's not going to be anything in China to sell. There's not going to be anyone to buy. They can maybe sell domestically to their gold holders, and gold and silver holders, but most of the Chinese are also broke because instead of going to gold, they bought a bunch of real estate. So to say that if you think the Communist Party of China is somehow doing better than us, then we should not have a free society. Then communism works, right? If you think if you think China's beating us, then that means communism works, and maybe we enjoy our personal liberties better, but communism is now a better state. And
Well, I didn't say that.
Yeah.
I'm just
I know you didn't. There are Chinese.
I'm
Chinese
just reporting on the injection of funds.
Yeah,
But
absolutely.
I think China, though, has a lot more gold than they tell us publicly. They've got a lot more than 2.3 thousand tons.
That's also not that's not necessarily a good thing, because
Yeah.
gold has having lots of gold in a system. I'm not talking about a person, because people mistake what I'm trying to say. For a person, yes, you always want to go seek out as much gold as possible. When a system has a lot of gold revolving around it, you only get two things. You get more jewelry and you get higher prices. So if China reveals they have 30,000 tons of gold, like that, like we think they might, then that means prices in China in gold terms are going to be sky high, and prices everywhere else are going to drop like a rock because we will want to sell them stuff to get their gold. Now, what's that going to do to Chinese industry? It's going to collapse it. Chinese export-based industry when prices are sky high in China. So they have all kinds of problems on their end too. It's not like they are not outsmarting us. They're not outsmarting the system. The system is stealing from everybody around the entire world. And we Americans are sitting in drowning in debt. And in China, they're slaving away for American debt that's not worth anything. So they're slaving away for nothing.
Both the US and China face mounting economic pressures. Whether it's America's debt-driven push toward hard assets like gold and silver or China's struggle to sustain growth amid a real estate bust and reliance on weakening US demand. Precious metals are increasingly seen as safe havens in this fragile global system, and their rising momentum underscores a deeper shift away from trust in paper assets. Could silver's potential designation as a strategic resource accelerate its price far beyond current projections? If China reveals its true gold reserves, would that stabilize its economy or trigger more volatility worldwide? Feel free to share your feedback in the comments below. If you found this helpful video, hit the thumbs up and subscribe to keep up with our latest updates. We appreciate you being a part of this journey.
China is buying gold like crazy. The people in China are buying gold. They love gold, and the central bank is also buying gold on a consistent monthly basis, basically. China is the largest gold producer already, and they consistently buy more gold. They use this, of course, as a way also to attack America, because gold is the antidote to the American fiat dollar money system, and they plan to build gold vaults in many other countries. Gold is clearly in a secular bull market. The only caveat would be if we see gold now really accelerating dramatically over the next few months and maybe 1-2 years, doubling in price immediately and running to maybe 8,000-9,000 in the next 1 or 2 years, then it would probably have the characteristics of more of a bubble, and we would have to be careful. But if it's just pushing higher like it's been doing now the last 14 months, I think it's very healthy, it's very sustainable.
China is both the largest gold producer and a heavy buyer, with its people and central bank consistently accumulating gold as a hedge against the US dollar. China is building vaults abroad to back trade in yuan with gold, challenging the dollar system. China's central bank has increased its holdings of gold for 10 months in a row, ending in August 2025. Their gold reserves rose to about 74.02 million fine troy ounces. Gold is in a long-term bull market, and while a sudden surge to $8,000 to $9,000 within a year or two could signal a bubble, the current steady rise looks healthy and sustainable, pointing to much higher prices ahead. Florian Grimmies, a precious metals and cryptocurrency analyst and investor, highlights that central banks in China, Russia, and India are buying gold instead of Bitcoin, while the US is pushing into digital assets to maintain dominance, raising concerns about surveillance and sustainability. A World Gold Council survey shows 76% of central banks expect to raise gold reserves in the next 5 years. China has boosted its gold reserves for 10 straight months, joining Russia and India in favoring gold over Bitcoin, which remains too volatile and unrecognized as a reserve asset. Rising stagflation risks, low growth plus high inflation, are driving demand for hedges like gold and real estate. Analysts warn that while gold's inflation-adjusted price is at record highs, steady demand could lift it toward $3,700 to $4,000 per ounce by 2026. Tracking wealth in gold or Bitcoin, rather than just dollars, shows how purchasing power continues to decline. As we dive into the video, don't forget to hit the bell icon and subscribe so you don't miss any updates.
The Chinese, the Russian, and the Indian central bank are buying gold and not Bitcoin. The Americans desperately need something new to continue basically running their hegemony. And apparently they decided it's going to be the digital asset space. It makes sense to a certain level. At the same time, a digital dollar as a stable coin is just really much better. No, it's not. I mean, I'm very much worried about the whole surveillance kind of thing. I'm not sure if Trump himself really understands the whole thing. I think he has a lot of advisors who are telling him what to do and what to say, but if he really understood it, I don't know. It probably is the last chance that America can do, because they are not having enough gold.
You know, it's interesting. I read recently that Trump's assets, his corporate and family assets, have shifted from real estate predominantly to now crypto and Bitcoin predominantly.
Of course, it's amazing. I mean, who would have thought that, right? A year ago. To a certain extent, I would say yes. I mean, I think, first of all, the Trump family just wants to make as much money as possible.
Okay.
So that's, I think, the major intent here. And I think it's very questionable what's going on here. Very questionable. But at the same time, of course, I mean, the administration before was also extremely questionable because they were completely against it.
Yes.
Didn't allow any invention here and progress. So I at least that's what I appreciate now with Trump. But I think it's a turbo casino capitalism kind of style here. And Trump makes sure that his family makes a fortune here. And anything else, I don't know. Is it really better? I mean, yes, they create more demand for US treasuries if people buy more Tether, and then this is getting converted into the crypto market. Yeah, okay, but is this really sustainable? I don't know. I mean, the whole thing is more and more questionable in my opinion. Yeah, exactly. That's what's going on. On the one hand, massive expansion of the money supply, and not only in America, all over the world. If you look at these numbers for the European Union, if you look on Japan, on China, everyone is basically printing money. And on the other hand, the consumers are losing the confidence in these currencies, in these fiat currencies, because they see that they have less and less purchasing power. And so people are trying to escape into hard assets. And that's why, at the end of the day, real estate is still holding up rather well. Okay, there is regional differences, but overall, it's holding up well. And in many areas, actually, real estate is still getting more expensive. Your stock market overall, even though there's lots of questionable things happening in the economy, and you see that basically a stagflationary kind of scenario, the stock market is higher because people buy these stocks as a hard asset, so to speak, moving their money out of the fiat world. And gold, precious metals, mining stocks are moving higher, and crypto as well. And even your rare stamps and your old timers are getting more expensive because the fiat money is losing purchasing power and people losing confidence. I mean, you can see in many countries the society is becoming rather unstable. Some of them are actually close to a civil war. These are all the consequences out of it, and this is just continuing. You know? I don't see a turnaround. It basically says that on the one hand, central banks, politicians, increasing the fiat money supply, basically printing money out of thin air. And on the other hand, consumers and participants in these financial systems are losing the confidence because they can see that the purchasing power of their fiat currencies is diminishing by the day in the end of the day. And that's basically happening at the same time. And what it means is your assets or your investments can go up on a nominal basis, while in real terms, they haven't moved at all. But people only look at the value of their assets in nominal terms, meaning in dollar. I mean, how many people are actually looking or calculating their net worth in Bitcoin and in gold ounces? It gives you a totally different picture over a 5 or 10 year time frame than just looking at it in terms of how many US dollars am I in total, or how many euros or Canadian dollars, right? So I'm doing this as a little homework every 4 months. Updating a little Excel sheet, tracking my net worth, and you can see how challenging it can be actually to keep up in terms of Bitcoin and gold with your total net worth. You know, you might have more euros or dollars, but not more Bitcoin and gold.
Florian recalls, in 2022, when the Fed hiked rates, Bitcoin crashed, and gold dipped but held much stronger as a safe haven anchor. Since its triple low 3 years ago, gold has risen over 130%, supported by four key drivers: expanding global money supply, the bond bear market pushing institutions toward gold, massive central bank buying since sanctions on Russia, and China's relentless gold accumulation for both citizens and reserves. China, already the largest producer, is building vaults abroad to back trade in yuan with gold, challenging the dollar system. This shift is unwinding decades of paper gold price manipulation, as physical demand now drives the market. Beijing is also making gold imports/exports easier. It's seeking feedback on streamlining licensing processes, longer valid licenses, more customs offices authorized, to smooth gold trade. China's consistent accumulation supports the idea that demand from major sovereigns is backing gold's secular bull market. The fact that China is pushing through regulatory/reform steps for gold import licensing underscores a long-term strategy rather than a short-term bet. Central banks globally continue with strong, steady gold purchases in the face of geopolitical risk, inflation, and concerns about U.S. dollar reserve dependency.
First of all, in that 2022, when the Fed started hiking interest rates and everything came under pressure, Bitcoin went down to $15,800 from $69,000, and gold came down to $16,15 from 2070-ish. And had a triple low, more or less 3 years ago. But gold held up much better during that time than everything else. So I remember being very happy having a large chunk of my portfolio in physical gold, because it basically stabilized and was rather a safe haven anchor in that time when everything else was plummeting. So since then, yeah, gold is up 130% since that triple low 3 years ago. And you asked for the driver. So in my presentation yesterday in the morning here at the conference, I presented my take on it. I think there's 4 big, very important macro drivers for gold. The first one, I mentioned it before already, M2, money supply, the liquidity basically in the system, constantly being expanded over the last few years, and especially now again in the last few months. And not only in America, but also in the Eurozone, in Japan, in China, wherever you go, basically. If you would look at South Africa or Brazil, you would basically see similar numbers. So liquidity expansion. Second big driver is the bear market in bonds, especially in the long-term bonds. So the long end of the bond market, I think the Fed has lost control over it already. We have still a rather persistent inflation. And if you're an institutional investor and you have to seek safe, conservative, long-term bonds, and now you're in a bear market in bonds, it's very challenging. So I assume more and more institutional money will go into gold because it's the only other asset that they can buy. So that's the second driver. The third driver is central bank buying. We haven't seen that in like decades, that strong demand from central banks. Of course, it increased dramatically since Russia invaded Ukraine, when the whole world realized, like, whoa, the Americans, NATO, the Europeans just can confiscate our assets whenever, however they want. So now lots of emerging market central banks and nations are trying to diversify themselves out of the dollar, out of the euro, de-dollarization. Central banks are buying gold. They don't chase gold, but they also don't really care about $100, $200. So that's exactly what we've seen over the last 14 months. Whenever there was a consolidation in gold, you didn't really have a big pullback because very quickly physical demand showed up in the market again. And the last one, which is also very important, probably the most important besides the central banks, is China. China is buying gold like crazy. The people in China are buying gold. They love gold. And the central bank is also buying gold on a consistent monthly basis, basically. China is the largest gold producer already, and they consistently buy more gold. They use this, of course, as a way also to attack America, because gold is the antidote to the American fiat dollar money system. And they plan to build gold vaults in many other countries. Yeah. So if they do their trade business with Saudi Arabia and they buy the oil from the Saudis, they will give them the renminbi, and the Saudis can take these renminbis, go in their own country, go to the vault, here's the paper renminbi, show me the gold. I mean, this is what the Chinese are working on, to inject confidence into their yuan kind of system building an alternative system to the US dollar system. And that's not going away. Those four drivers that I just mentioned, I mean, they're going to be around for the next 1, 2, 3 years at least. It could maybe take a decade or even longer until this fully plays out. And I think during that time, gold will be strongly supported. There will be strong physical demand. And out of the consequences also out of those four drivers is that you are seeing now the unwinding of that 50 plus decade Anglo-Saxon paper gold Ponzi scheme kind of system, right? Yeah. So we know that in the past five decades, the price making or the price finding for gold has been dominated by trading 200 paper ounces of gold for 1 real ounce of gold. That's how mainly the price finding has basically happened. And this is being unwinded now. And this can take a long time. And again, I just mentioned it before, gold is super strong, no real pullbacks here, no dips, people chasing, running behind the train, it just pushes higher. And whenever there is a dip, immediately big hands showing up with physical demand. And I think it's super bullish. Gold is clearly in a secular bull market. I think the price targets that you and I were talking about 5 years, around $9,000, if you remember.
Yeah.
I think that's still the case. We probably have to revise them, and it's probably gonna go even higher. The only caveat would be if we see gold now really accelerating dramatically over the next few months and maybe 1-2 years, doubling in price immediately and running to maybe 8,000-9,000 in the next 1 or 2 years, then it would probably have the characteristics of more of a bubble, and we would have to be careful. But if it's just pushing higher like it's been doing now the last 14 months, I think it's very healthy, it's very sustainable, and we're going to see much higher prices. And this can last for at least a few more years, at least.
Could China's gold-backed trade strategy accelerate the decline of dollar dominance in global finance? How might central bank gold buying continue to influence prices compared to private or retail demand? If you enjoy the content, please like this video, subscribe to the channel, and press the bell icon for timely updates. We appreciate your support, thank you for being with us, and wait for the next updates.
And the price of gold has, it's more than doubled, actually tripled in the last couple of years. So the thing with gold, just in U.S. dollars, going from say $1,500 per ounce to $3,500 per ounce, which was the recent all-time high. What really happened is the dollar has gone down significantly relative to gold. It's a weakening of the dollar. Now, the dollar has performed much better against other currencies. Recently, very recently, last 4 or 5 months, the dollar has gone down, the major indices, but that was from a fairly high level. It actually got quite strong against all the other major currencies. So I expect the dollar to get weaker against other major currencies. But if you're talking about gold, I would expect the opposite, that the price of gold would go up, which means that all the other currencies are falling even faster. So I would expect the Aussie dollar to get stronger relative to the US dollar. I do expect it to go higher. There's no way that gold is going to double or triple, and silver won't be along for the ride. So you can see $100 silver at some point and even higher from there.
Gold has jumped from $1,500 to $3,500 an ounce in just a few years, not because gold changed, but because the US dollar lost value against it. Though the dollar recently strengthened against other currencies, it's expected to weaken further, with all major currencies losing purchasing power even faster. JP Morgan notes that central banks are accelerating de-dollarization, cutting dollar reserves and boosting gold holdings, with the dollar's share of global FX reserves now below 60%, its lowest in 20 years. Meanwhile, silver is likely to follow gold's rise, potentially hitting $100 or more per ounce. Jim Rickards, an American lawyer, economist, and investment banker turned financial commentator, mentions the U.S. is deliberately pursuing a weaker dollar under what's being called a Mar-a-Lago Accord, tying tariffs, trade policy, and even military protection to currency values. Morgan and Reuters highlight expectations of a weaker U.S. dollar ahead. Asset management models suggest the dollar is overvalued by 10 to 20% against currencies like the euro and yen. At the same time, a softer dollar through 2025 is seen supporting emerging markets, attracting investors toward higher-yielding assets outside the U.S. However, Jim Rickards predicts the U.S. will devalue the dollar, but partners must not devalue their currencies in response. As a result, currencies like the Aussie dollar, sterling, and Swiss franc are expected to strengthen because the US is actively forcing it. To ensure you don't miss any updates, don't forget to hit the bell symbol and subscribe as soon as the video starts. If you like the content, please let us know by leaving a comment below.
I would expect the Aussie dollar to get stronger relative to the U.S. dollar, but there's a very specific reason for that. There's a lot of buzz around the world of the BRICS are coming up with an alternative currency, and people are getting out of U.S. Treasuries and losing confidence in the U.S. dollar. U.S. budget deficits are out of control. The U.S. debt is out of control, et cetera. And none of that is basically true. These are talking points, but they have to be put in a context. The U.S. debt, $37 trillion, that's a big number, for sure. But you can't think about that without comparing it to the resources. What is the GDP behind the debt? What are the assets on the other side of the balance sheet? And those kinds of things the Trump administration is talking about. And so one of the most influential advisors in the White House right now is Stephen Moran. He's an economist, but he wrote a paper last November on basically reconfiguring the entire global trading system. Pretty big claim. In there, he calls for something called the Mar-a-Lago Accord. And by the way, that was the title of Chapter 6 of my book, Aftermath, which came out in 2019, last time I was in Australia. So I'll take credit for coming up with the name. But his version of the Mar-a-Lago Accord looks at tariffs, trade, and exchange rate values, and kind of getting to your question, Jordan, about the Aussie dollar. Now, let's say I put 20% tariff on it. I'm the United States, and I put a 20% tariff on a trading partner. So some goods are, let's just say 100, it could be 100 million or whatever, but 100 as a measure, and I throw a 20% tariff on it, now it's 120. But what if the trading partner devalues its currency by 15%? So it was at par, let's say hypothetically, and you drop it from 100 to 100 down to 85 to 100. Well, that negates the impact of the tariff, because yes, the tariff marks up the price, but if you're the producer and you can lower your local currency costs, your labor costs and so forth by devaluing your currency, you dilute the impact of the tariff. So what he is saying, and indirectly what the White House is saying to U.S. trading partners, is we're going to put these tariffs on, so that's a given, but don't you dare devalue your currency. Sure. We're going to devalue the dollar. And any trading partner that tries to offset the tariffs by devaluing its currencies, there are going to be consequences to that. And he uses what I call the traffic light system. He says red, yellow, green. In the U.S., that's traffic light. But he said we're going to divide U.S. trading partners into 3 categories. So green, you're a friend, you work with us, we've negotiated the tariffs, you accept the tariffs, and you accept the fact that we're going to devalue the dollar. Yellow, you're okay, you're not an enemy, but you're not our best friend, and you may suffer higher tariffs. Red, you're an adversary, clearly China and Russia. I think it's a mistake with Russia, but China and Russia would be in that category. You're going to get tariffs, if not sanctions, etc. But in addition, this is where it gets tricky. He injects national security considerations. Like, wait a second, this guy's an economic advisor, maybe a Fed governor, but what's he doing talking about national security? Sounds like Henry Kissinger. But he said, if you're in the green category, you will get the benefit of U.S. military protection. Sure. You'll get the nuclear umbrella and more. If you're yellow, we may work with you. And if you're red, you can expect that we'll be in an adversarial position. So the significance of that is he's putting military might and security guarantees behind his claims about the U.S. dollar and exchange rates. Now, that's only been done twice in U.S. history. One was between 1971 and 1974, when Richard Nixon closed the gold window. It suspended the ability of foreign trading partners to redeem dollars for gold. The second time this was done, where the goal was to devalue the dollar, was 1985. James Baker was Secretary of the Treasury. Ronald Reagan was president, but Baker really took the lead on this. And using some of these indices I mentioned, the dollar was at an all-time high, and the Baker said, no, it's not good enough. We have to devalue the dollar. So the dollar dropped about between 15 and 20%, depending on the cross rate at the time. So here's the third instance of the U.S. engineering a devalued dollar. This isn't the markets doing this. This is the U.S. Treasury insisting on it. So I look at the Aussie dollar, sterling, Swiss francs, euro, and say, you're all going to get stronger because the U.S. wants that. The U.S. is forcing that to happen and backing it up with some pretty nice rewards, carrots on the one hand, but a stick if not.
Jim Rickards recalls that since 2010, central banks have shifted from being net sellers to consistent buyers of gold, led by Russia, China, and others steadily accumulating reserves. China, Russia, Turkey, and India have led global central bank gold buying in recent years. China resumed reporting reserve increases in 2022 to 23, adding over 150 tons in early 2023. Russia keeps buying domestic gold while cutting U.S. treasuries. Turkey continues heavy purchases despite economic strains. And India steadily grows reserves while reducing dollar reliance. Eastern European banks like those in Poland, Hungary, and the Czech Republic have also accelerated gold accumulation. Overall, BRICS nations now account for the bulk of central bank demand, far outpacing Western buyers. In addition to this, central banks now hold 36,000 tons of gold, surpassing their treasury holdings in value for the first time since 1996, valued at approximately $4.5 trillion versus $3.5 trillion in treasuries. For the last 3 consecutive years, central banks have purchased over 1,000 metric tons of gold annually, roughly double the pace seen in the preceding decade. A World Gold Council survey shows 76% of central banks plan to increase gold holdings over the next 5 years, while nearly 75% expect to reduce exposure to U.S. dollar assets, a sign of accelerating de-dollarization. Jim believes this central bank buying creates a price floor for gold while leaving unlimited upside, making it a strong long-term play. Now let's delve into the interview.
Well, you're exactly right, Jordan, about the central bank buying, and the turning point, you can actually chart this, was 2010, but right after the global financial crisis of 2008. From 1970 to 2010, central banks and finance ministries, sovereign wealth funds were net sellers of gold every single year. Beginning in 2010, central banks collectively became net buyers of gold. Russia has more than tripled its gold reserves from about 600 metric tons to almost 3,000 metric tons. I guess it's gone up closer to 5 times. Same thing with China, from about 600 metric tons to 3,000 metric tons. But we've also seen Japan go from 600 to 900 metric tons, etc. Kazakhstan, Vietnam, Philippines, Mexico, Turkey, Iran. Iran's not transparent, but they've been buying gold, etc. So you have this fairly large group of central banks who are buying gold. Where are the sellers going? So between 1970 and 1980, the U.S. sold 1,000 tons. We went from 9,000 metric tons to about 8,100, just a little over 8,000 metric tons. But the U.S. stopped cold. We never sold any gold after 1980. And there are reasons for that. Probably don't have time to go into them. They're highly technical. But so the U.S. has stopped selling gold. We're no longer a seller. We've just stopped at 8,133 metric tons. So the sellers went away. The buyers continued. They will continue going forward. And what's interesting from a gold investor's point of view, central banks and finance ministries are actually very smart buyers. They don't chase the market up. They buy the dips. I hate to use cliches, but they buy the dips. They put in just steady orders. They're not out to buy the whole everything they need at once. It'll be 20 tons a month, which Russia did. Central Bank of Russia was very transparent. By the way, just as a quick aside, Elvira Nabiullina is the head of the Central Bank of Russia. In my view, she's the only central banker in the world that actually understands her job. But she put 25% of Russia's reserves in physical gold stored in Russia between 2010 and 2022, which was the beginning of the war in Ukraine. So what did the U.S. do? Well, the U.S. and Europe froze $300 billion worth of U.S. Treasury securities that Russia had bought lawfully. They shipped oil, got dollars, bought Treasury securities, trusted the United States, which was, hindsight, turned out to be a mistake, So there are about 200 billion of Treasury security, Russian-owned Treasury securities in Euroclear. That's all been frozen. The U.S. does it all the time. We're good at freezing things, but now they're stealing it. They're actually seizing it and using it and the interest on it as collateral for loans to Ukraine, so that Ukraine can buy weapons to fight Russia. So Russia's own money is being used to fight Russia via Ukraine. But why hasn't Russia crumbled? Well, the answer is they had $150 billion in gold that the U.S. can't touch, can't freeze, can't seize. And that's one of the nice things about gold. It's not digital. I can't hack it. It's just there. Unless you want to invade Russia, which is a whole different thing. And one of the ironies is when the U.S. put all these sanctions on Russia, every sanction you can think of, they've failed. But one of the reasons was they had gold, and Russia has actually made $50 billion in mark-to-market profits on their gold reserves. So on the one hand, we are stealing their treasury securities, but by doing so, we're helping to create geopolitical risk, drive up the price of gold. And Russia has more than $50 billion profit on the gold. So kind of what goes around comes around. Now, here's the thing. From a gold investor's point of view, I like this. This is what is called an asymmetric trade, meaning with a central bank buy, you have a floor. It's not a hard floor. There's no guarantee, but you have a de facto floor under the price of gold, but you have unlimited upside. So you can buy gold with some confidence that it's not going to go down a lot because the central banks will just buy it. At the same time, the sky's the limit in terms of where it might go. So it makes gold a very attractive trade. I should be clear, we are not at the frenzy stage yet. This rally has a long way to go. And the reason is it is a precious metal, exactly as you described, Jordan, but it's also an industrial input. And so the price moves on both vectors. So as a precious metal, I do expect it to go higher. There's no way that gold is going to double or triple, and silver won't, be along for the ride. So you can see $100 silver at some point, and even higher from there. But at the same time, if we're going into a recession, which I expect we are, and manufacturing is declining, and everywhere from China and the U.S. as well, Europe, all over really, then there might be less demand on the industrial side. Although it's demand for electronics is still strong. So you've got sort of two forces. It's going to go up on the precious metals vector, but maybe lag a little bit in terms of the industrial input vector. But on net, I do expect silver to go up.
Do you think central banks' move toward gold signals the beginning of a new monetary order? Could silver outperform gold in the years ahead as industrial demand recovers? If you have any comments, please share them here. In order to receive our latest updates, please subscribe and leave this educational video a review. We appreciate you coming along on this journey.